Something unprecedented may be forming beneath the surface of global markets, and it could trigger the biggest reset in gold in modern history. At a time when geopolitical tensions are rising, when war risks are expanding, and when the global financial system is already under pressure, a new narrative is beginning to take shape, one that links political power, monetary policy, and gold itself. And at the center of that narrative is a name that continues to reshape expectations: Trump. Because this is not just about gold prices moving up or down. This is about the structure of the system that determines how money works and whether that structure is about to change. Gold has always been the ultimate anchor of trust. When currencies weaken, when inflation rises, when systems come under pressure, gold becomes the fallback. But today, something unusual is happening. Despite rising global instability, gold's behavior has become increasingly unpredictable, held back at times, volatile at others. And that raises a critical question. Is the market being positioned for something bigger? The idea of a reset is not new, but it is rarely felt this close. A reset implies a shift in how value is measured, how currencies are backed, and how global trade is structured. And in moments of high geopolitical tension, these kinds of shifts become more likely, not less. From one perspective, aggressive monetary tightening, rising debt levels, and global conflict are pushing the system toward a breaking point. From another, political influence and strategic decision-making could accelerate that process intentionally or not. Policies around trade, currency, strength, and economic control all feed into this equation. And this is where the concept becomes uncomfortable. Because if gold is being repositioned not just by markets, but by policy and power, then what comes next may not be gradual. It may be sudden, a repricing, a shift in perception, a moment where the role of gold changes in real time. At the same time, global conflicts are putting pressure on supply chains, energy markets, and financial systems. These pressures do not operate in isolation. They interact, they amplify each other. And when they reach a certain threshold, they can trigger outcomes that seem unthinkable until they happen. This is why the idea of a gold reset is gaining attention, not as a certainty, but as a possibility that is becoming harder to ignore. If you want to understand how war, politics, and financial systems are converging and what a potential gold reset could mean for your future, subscribe now. Because if this shift happens, it won't come with a warning. It will come all at once. To understand how the idea of a gold reset is even possible, it's necessary to look at the long-term evolution of the global monetary system. For decades, the system has been anchored not by gold, but by confidence in fiat currencies, especially the US dollar. After the collapse of the gold standard in the 1970s, currencies became backed by economic strength, policy credibility, and global demand rather than physical assets. This allowed unprecedented expansion. Debt levels rose, money supply increased, and financial markets grew more complex. For years, this system functioned because trust remained intact. But over time, cracks began to form. Rising debt, repeated financial crises, and increasing reliance on central bank intervention have gradually eroded confidence beneath the surface. More recently, geopolitical tensions have added a new layer of pressure. Sanctions, trade conflicts, and regional wars have pushed countries to rethink their dependence on a single dominant currency system. Some have begun exploring alternatives, diversifying reserves, increasing gold holdings, and experimenting with new settlement mechanisms outside traditional frameworks. At the same time, aggressive monetary tightening has introduced a different kind of stress. Higher interest rates are exposing the limits of a system built on cheap money, forcing adjustments across markets and economies. This creates a convergence, long-term structural weaknesses meeting short-term financial pressure. And in that convergence, the idea of a reset becomes more than theory. It becomes a potential outcome of a system struggling to rebalance itself under multiple strains at once. As these pressures build, the mechanics of a potential reset begin to come into focus. It would not start with a single announcement or a clear signal. Instead, it would emerge through a series of shifts, policy changes, market reactions, and geopolitical decisions that gradually alter how value is perceived. One of the first indicators would likely be instability in currency relationships. As confidence fluctuates, exchange rates become more volatile, forcing central banks to intervene more frequently. At the same time, demand for hard assets like gold can begin to rise beneath the surface, even if headline prices do not immediately reflect it. Financial markets would also play a critical role in this transition. Large institutional flows, central bank reserve strategies, and sovereign decisions could all contribute to a rebalancing of assets. If certain countries begin increasing gold reserves more aggressively, or if trade agreements start incorporating alternative settlement methods, the foundation of the current system could begin to shift. These moves may appear isolated at first, but collectively they signal a broader change in direction. Geopolitically, the environment becomes more complex. Nations facing economic or strategic pressure may seek greater independence from existing financial structures, especially if those structures are perceived as tools of influence or control. This can accelerate fragmentation, where instead of one dominant system, multiple parallel systems begin to emerge. In such a scenario, gold's role becomes more prominent, not just as a store of value, but as a neutral asset that can bridge different economic blocks. At the same time, domestic pressures within major economies add another layer of uncertainty. High debt levels, rising interest costs, and political considerations can influence monetary decisions in ways that ripple outward globally. Policies designed to stabilize one part of the system can create stress in another, contributing to an environment where traditional relationships break down. What makes this process difficult to predict is its nonlinear nature. Long periods of gradual change can be followed by sudden adjustment. Markets may appear stable until a tipping point is reached, at which point reactions become rapid and widespread. In that moment, assets that were previously overlooked or undervalued can be repriced quickly. This is how a reset would likely unfold, not as a single event, but as a chain reaction. And once that chain reaction begins, it becomes increasingly difficult to control. What makes the idea of a gold reset even more significant is the strategic role it could play in a world increasingly defined by fragmentation. As global tensions rise and alliances shift, the financial system is no longer operating as a single unified structure. Instead, it is beginning to divide into competing blocks, each with its own priorities, risks, and economic strategies. In such an environment, trust becomes more difficult to maintain, and neutral assets like gold gain importance. From a strategic standpoint, gold offers something that fiat currencies cannot: independence from any single government or policy decision. This makes it uniquely positioned in a world where economic relationships are becoming more politicized. If countries begin to prioritize sovereignty over integration, the demand for assets that can operate outside traditional systems could increase significantly. At the same time, the interaction between war and finance is intensifying. Conflicts are no longer limited to physical battlefields. They extend into energy markets, trade routes, and financial systems. Sanctions, currency controls, and economic pressure are being used alongside military strategies, blurring the line between economic policy and geopolitical action. In this context, control over financial tools becomes as important as control over territory. This is where gold re-enters the conversation at a deeper level, not just as an investment, but as a strategic asset. Central banks may adjust their reserves not only based on economic considerations, but also on geopolitical positioning. A shift toward gold could signal a desire to reduce exposure to external influence and increase financial autonomy. At the same time, markets remain highly sensitive to policy signals. A change in interest rates, a shift in fiscal policy, or a new geopolitical development can quickly alter the balance. This creates an environment where expectations matter as much as actions. If enough participants begin to anticipate a reset, their behavior alone can accelerate the process. What emerges is a system under transformation, one where old assumptions no longer fully apply and new dynamics are still forming. The role of gold within this system is not fixed. It is evolving in response to forces that are larger than any single market or policy decision. And when those forces align, even briefly, the result can be a shift that feels sudden despite having been years in the making. According to financial strategists and policy analysts, the probability of a major shift does not come from a single trigger, but from the accumulation of pressures reaching a point where adjustment becomes unavoidable. Intelligence-style assessments increasingly focus on systemic stress indicators, rising debt burdens, tightening liquidity, and geopolitical fragmentation as signals that the current framework is being tested in ways it has not been in decades. In this environment, gold is not just reacting, it is being positioned. Experts point out that central banks are now operating under constraints that did not exist in previous cycles. High interest rates are necessary to control inflation, but they also increase the cost of servicing massive debt levels. Lowering rates too soon risks reigniting inflation, while keeping them high for too long risks slowing growth and destabilizing financial markets. This creates a narrow path with limited room for error, and when policy options become constrained, the likelihood of unintended consequences rises. There is also growing attention on the role of global capital flows. As financial conditions tighten, capital tends to concentrate in stronger economies and currencies, reinforcing imbalances across the system. Emerging markets face outflows, currencies come under pressure, and central banks are forced to respond, sometimes by increasing gold reserves as a form of stability. These responses, while defensive, contribute to a broader reallocation of assets that can gradually reshape the system. Geopolitical analysts emphasize that economic pressure is now a central component of global strategy. Sanctions, trade restrictions, and currency policies are being used to achieve objectives that were once pursued primarily through military means. This increases the importance of assets that can function outside these mechanisms. Gold, by its nature, becomes a strategic tool in such an environment. At the same time, market behavior is becoming more reactive. Volatility is increasing, and price movements are often driven by expectations rather than fundamentals. This sensitivity can create conditions where shifts happen quickly once a certain threshold is reached. What these perspectives suggest is not inevitability, but possibility. A system under pressure does not always break, but when it does, it rarely does so gradually. And if a reset begins, it is likely to unfold faster than most anticipate, driven by forces that have been building quietly over time. But there is a competing interpretation that challenges the idea of an imminent reset. Some economists argue that the system, while under pressure, remains far more resilient than it appears. They point out that despite rising debt, geopolitical tension, and policy constraints, the core infrastructure of global finance, deep capital markets, central bank coordination, and the dominance of major currencies continues to function. From this perspective, what looks like a potential breaking point may actually be a period of adjustment. This view emphasizes that transitions in global monetary systems historically take years, often decades, rather than unfolding suddenly. Even when pressures build, policymakers tend to respond incrementally, adjusting interest rates, providing liquidity when needed, and stabilizing markets during periods of stress. These mechanisms can delay or soften the kind of abrupt shift that a reset would imply. There is also the argument that gold's role while important, does not automatically expand in every crisis. Its behavior depends on a range of factors: interest rates, currency strength, and investor sentiment. In a high rate environment, even during geopolitical tension, gold may struggle to attract flows if alternative assets offer better returns. This does not mean its long-term value is diminished, but it does explain why its response may appear muted or inconsistent. Additionally, some analysts suggest that the current environment reflects a rebalancing of expectations rather than a fundamental change in structure. Markets are adapting to a world where inflation is no longer negligible, where central banks are more aggressive, and where geopolitical risks are more visible. In this context, volatility is not necessarily a sign of breakdown. It can also be a sign of recalibration. From this perspective, the narrative of a gold reset may be overstated. The system may continue evolving without a single defining moment, with changes occurring gradually through policy shifts, market adjustments, and strategic decisions over time. Yet, even within this more measured view, there is acknowledgement of one key point. The conditions now are unusually complex. Multiple pressures are interacting at once, and the margin for error is smaller than it has been in years, which means that whether the shift comes suddenly or unfolds slowly, the direction of change may already be underway.